because I'm very excited about this class that we're offering with Stan Weinstein, and I'm going to be very straightforward. I think every one of you should be taking this. He's put in quite a bit of time with us over the past month plus to come up with recordings, and it's about it looks like it's going to be about 5.5 hours to 5 to 5.5 hours of him teaching you guys concepts. So we've recorded everything. Everything's, from a recording standpoint is complete. He's super excited. One of the messages that he had near the end of in the last interview that we did with him was, "This is my best work since I wrote my book." And he's given it his 100%. We've had interviews go for a span of 2 hours. He's on the phone with his clients all day. And then he spends 2.5 hours with us. So there's a lot that's gone into this, and the amount of effort, to expect from Stan Weinstein at his age, and, interfacing with institutional clients only for the past 30 years to come to the retail side and do this masterclass with us is just remarkable and amazing. So highly encourage you guys to do this. If you're an annual private access member, you get a massive discount, and you should have got emails for that. It's literally paying for your private access annual membership. So that's the idea, that with the university pass for annual private access members is the membership should pay for itself. We'll have more partnerships in the future that will literally, the membership will pay for itself, because the public pricing is $12.97, as you guys know, at the moment. And for annual private access members, you guys know the discount that you're getting. It's north of $500 to $600. So we will be releasing another audio, which was sort of like a sign off from him. He's super pumped about getting this out there. We're working hard behind the scenes trying to make everything look good. It's all hands on deck. Everything that we put out is being reviewed by Ross as well at the same time. So this is going to be a super high quality product that we release on July 30th. Several questions that have come up. Does the price include all 10 modules? Of course, we're not going to sell one module for $12.95. That has never been the case. Our goal is to get as many people into this course as possible and make it as affordable as possible while keeping it fair to Stan. Because honestly, his newsletter costs about $10K for his institutional clients, and for him to do this for the price that we're offering it is kind of ridiculous. So, but we're able to negotiate a very good deal for everybody, and we think it's going to be we think this is going to be amazing. And when we say that, you got, given the quality of the Oliver course, if you guys have taken it, or any other partnerships that we've had on the university side, I feel like this is going to be one of the best products that we put out there. Yeah. So any questions, you can email support@traderline.com. Gary is working on a Sunday to get your questions answered. And the university pass discount does end today if you're an annual private access member, and then we'll be bumping it up to the early bird pricing for annual members. So questions, concerns, email Gary. He has all the information that we could possibly give him. I really, I'm spending time on this on purpose because I really do think this is going to be a great product. And if you guys were to enroll in it, it's going to be a massive it's going to level up your trading in a way, in a positive way. So let's get to the agenda for today. The daily plan. So this is going to be, I don't prepare for these, or I don't have any statements in my head. I try to do this off the cuff so that you guys get a raw, conversation with me and what my thoughts are with the daily plan. So let's start with what the purpose of the daily plan is, right? The purpose of the daily plan is to give us a directional edge in the market. So what I mean by directional is we should have, either the market is trending with us and we want to be aggressive to aggressive and bullish, or the market is choppy, or the market is directionally to the downside. these are the three types of market that we operate in at any point in time. Either we have a solid trend with solid leadership, either we don't have a trend and we're sideways, or the trend is down and we get choppiness within the trend. That is the basics of how the market operates. If there are anything, any other types of market that I missed, do let me know. But the daily plan, what it does is when the market is trending, we're above the BP, right? When the market is trending, we're above the BP. When the market is trending downwards, we're below the bullet pivot. That's you could simplify the market down to a level, and that's what the daily plan is trying to accomplish. Is trying to give you a very mathematical, systematic number that says that if you're above the bullet pivot level, the trend or the possibility of the trend being bullish is greater than the possibility of the trend being bearish. If we're below the bullet pivot, we have to view the market, or we have to see the market from a bearish lens to see, to have that bearish bias so that we could operate directionally to the downside. If anything else that you gather from the daily plan, it has to be that the bullet pivot is giving you a trend level, and you want to be you're interested in the trend of the market. This is the M factor that we talk about, right? The other thing that the daily plan offers is it's daily levels, which we call the IPs. And the IPs are really for active traders. They're for swing traders. If you want to day trade them, you could day trade them. If you want to trade futures with them, you could even do that. And you could do that at a high success rate and at a high clip. So the IPs tell us, this is the day-to-day movement. So this is day-to-day movement. That's what the IPs are trying to tell us every day. If we open near an IP level, we expect directional movement from that IP level. If we open within two IP levels, somewhere in the middle, and they're not even close, it means we might just get, a choppy day sideways, or we might come up to attempt it, but we're not expecting directional movement on that day. So IPs are more for swing traders and day traders. BP is the overall trend, which is for, again, which applies to everybody. So swing traders, position traders, and day traders, right? As a day trader, you want the wind behind you. And if we're above the BP, you want to put on bullish positions. If you're below the BP, you want to put on bearish positions. And the same applies for swing trading and position trading. So these are the two components that make up the daily plan and the levels that we put out on a day-to-day basis. So let's get right into what the daily plan looks like and what's the structure of it. So we covered that the pivots we have an IP and a BP, and what to watch for. We're basically looking for, every time we go above the BP, liquidity returns to the market. By liquidity, what we mean is price on a per level basis. There's a lot of volume associated with it when liquidity is high, right? And when liquidity is low, what happens is we get rash movement or larger ranges from the high to the low of the day. So above the BP, liquidity returns to the market. Market participants return. Their uncertainty sort of goes away, and we see volatility dampen. That's what we get above the BP. Below the BP, we get rash movement on a day-to-day basis, and the market on a net basis is less liquid on a per price level, and we get movement. On an aggregate or net basis, we get a downtrend in the markets. So this is what the daily plan looks like. Again, this bolded level is your BP level. This is the most important level on the daily plan. These levels are IP levels. These are for swing traders and day traders to keep track of. And if the price were to come in, let's draw this out. So let's say price is opening at 39.95. We said that 39.80 is of interest and 4,005 is of interest. So what happened on Friday? If we visualize this, and what happened on Friday was we opened at 4,000, which was 5 points away from 4,005. And at that point, once we open we're near an IP level, what that means is we expect directional movement in the market that day. That's the assumption that we're making, and that's a consistent assumption that we make. Near IP, we expect directional movement, right? So that's a constant assumption that we've made. So what we got was we uppercut 4,005, right? We uppercut 4,005, we came right back in, and that told us that there's a possibility that this market is about to, head lower. And the confirmation we got was when price went to 39.80, did a slice of 39.80, and then trended down the rest of the day. So when we open near an IP, we know we're going to get directional movement. And when we break an IP level to the downside, which was 39.80, that confirms that breadth is about to stink. The breadth that on an aggregate basis, breadth is going to go down and stocks are going to go down, right? So, and that is exactly what we saw on Friday. And Friday was a really good and a really good example of what edge the daily plan gives us in the market. So we post a visualization at the end of every day, and you guys could take a look at it on a consistent basis. When we get an open near the IP, we will have a directional day. Now, that directional day does not mean every time it's going to be bearish to the downside. It might be, we might have had a situation where we're at 4,005, price opens around 4,000, we go up, come back in, hold, and then we rally up and out. So that would be directional movement to the upside. Price uppercuts 4,005, holds to 4,005, and rallies up and out towards 40.55 and 4,100. So those are possibilities that we could see when we and what I mean by directional. It's not just bearish bias. It's always there are two parts of the equation at all times. So that's the first page of the daily plan that we publish. The second one is basically a morning message. Morning message is usually for the weeks, it stays the same. I don't change it a lot because we do a weekend routine and we have a really clear picture of what we are planning for the rest of the week. And most of the time that doesn't really change at all. So this morning message, if I feel that I haven't communicated well enough, then I will update it. But if the underlying message remains the same, there's really no need to change it other than I'm changing this particular number, right? We're 4 days above the bull to pivot level, and we're about to expect the stress test in the market. So the second one is we have to be clear about what the leadership groups are. From a week to week basis, you should know what leadership, what's leading the market if the market were to rally to the upside. And if we don't have clarity on that, then you aren't really operating from a standpoint where you want the market behind you and you want the group behind you for the highest probability of success, right? So that's why I write these down. I try to make it a deliberate, I try to be as deliberate as possible to position in these leadership groups on a consistent basis. And sometimes you don't find those setups, like healthcare and biotech. I've had a tough time trying to get exposure in that space because I don't really see something that fits my entry tactics, or they're not trading as firm as I would like them. So sometimes it works out well. Sometimes the market pushes you the other way and you have to adapt, but you have to be clear about what leadership groups that you could possibly position in. The second one, this one almost, I try to change it depending on the market environment, the keys to successful trading. So at the moment, what we have to focus on, and really what we have been focusing on, is in a downtrend that is about to shift into an uptrend. You can't go from 0 to 200% exposure or 0 to 100% exposure, depending on if you use margin or not. We have to exercise. If one position starts working, take the dollars that we make from that position, put it into the next one as your risk, and you operate upon progressive exposure and you finance your risk as you go down. That is going to be the key when the trend turns. If you get in and you get too heavy too early, you're gonna run into a Friday type of environment where everything is shifting down and you have 100% exposure. And now you've put yourself in a situation that you should not be in whatsoever. So financing your risk from one trade to the next. And quite honestly, the last week, my exposure was about 27%. That was as high as I got before the market said, get out of IoT, get out of OLPX, get into, short the TQQQ on Friday for a 2 or 3% trade and go cash, right? So I was trying to build positions. I was trying to build exposure in the markets, and the market said, well, it's not working. So you got to get out. So as soon as, you know, as soon as you start losing cushion on your trades, that's the market telling you that it's not ready yet. And there's no reason to fight the market by putting on, heavy positions or 50 to 60% exposure in one trade this early in the trend. There will be a time and place to do that. There will be a time and place when we have 4, 5, 6 solars, a couple of healthcares, and many biotechs all going in the same direction. And the market is above the BP, and the groups are hot, and we have more names that we can't even, we're trying to decide which one's a better one. Right now, we just don't have that. And this concept of, finance your risk is going to save your ass in the long term. So the second one, protect your cost basis is something that I like to do. Is if I'm buying at 14, for example, IoT, if I bought at 14 in the wick, holding the 10-day, whatever the case might be, the stock trip, went up to 15, and you have a 5 or 6% winner. If your average winner at that point is about, let's say, 2 to 3% over the last 10 or 15 trades, you have to take, cut half a position off. And then if it were to reverse, you want to protect that cost basis at that point, because you don't want to hope and the price goes down to 13 and you're hoping that you've made a good trade. So protect your cost basis early in the trend. And always, if the market is ready to go, it's not going to make any excuses. It's going to be very, very obvious. Things are just going to work for you to the upside. You don't have to make any excuses. The market won't allow you to make any excuses. It's just going to rip to the upside. It's going to be a healthy environment. You're going to make a lot of money. When it's iffy is when traders lose a lot of money, right? We get very cute when the market is choppy. We have, progress 1 to 2 days, but then we fail to listen to it, and we step on a landmine that results in a lower equity curve. So the third point that I make here is basically have something that is going to make you money on a consistent basis, right? Have something when you're struggling, you can strip away all the layers in your trading and you just focus on that one thing to get back on track. I think it's very important to have something like that in your trading. For me, if I'm struggling and I can't get, in line with the market, what I'm basically doing is I would focus on the HV only. If I don't see it, I don't see it. I just don't want to lose money and try to, be something that I'm not in the markets at that point in time, especially when you're struggling and giving away money. So have that one setup that you could always fall back on. And that always goes down to, that's your personal, you have a setup that, gets you focused and back on track. And if you don't have it, spend some time. And it's not a 1 to 3 week thing. It's a 3, 6, 9, 12 month thing where you collect evidence, build your own confidence, and get on the same page. So mindset is always that when we're above the bull dip pivot, we will have a trend resumption to the upside, and we always focus on higher EC. Now, I want to focus a little bit and talk about EC. There's this thing that don't look at P&L intraday, because P&L will get you all emotional, and you will end up basically. So, sorry, I'm trying to look at the chat here just to see if there are any questions. No question. I'll cover those in a few, Shiny and Tom. But there's a notion out there that P&Ls will drive emotions, and you will end up giving away a lot more if you continue to look at how much money you're making. The flip side to that is reality of the market. And the reality of the market boils down to how you're performing, which is the equity curve. You're either performing or you're not performing. And I like to approach the market with some reality to it. Are we emotional? Yes, we're always going to be emotional. Do we need to learn how to handle emotion? You have to learn how to handle emotion for you to be successful in the market. For you to try to shy away from emotion, not look at P&L, not look at equity curves. I'm going to focus on my process, and that's the only thing that I'm going to be doing is just making good trades, and even though they're not working, and just triggering my setups. That's fine to an extent. It might be, something to do 1 to 3 months, but in the long term, your equity curve is going to tell you. Your equity curve is going to tell you the reality of what is and what it is you're doing in the market. And as long as you don't, you can't shy away from emotion. Don't shy away from emotion. You're going to be emotional. If your P&L makes you emotional, then learn how to deal with it. Not, I'm going to hide my P&L and all that stuff. That might work in a good market, but the reality of the situation is if you're consistently losing money in the markets, there's a reason for that, and you need to look at that reason for you to turn these things around to at least look like this. Maybe choppy to the upside, but nonetheless, at least it tells you why you're losing money when you're looking at your equity curve. So that's a flip side of what many traders or people will tell you out there. It's just a different perspective. I like to deal with reality. I know I'm going to be emotional in my decisions, and I need to learn how to patch up those emotions, how to deal with them on a day-to-day basis. Again, if you want to make a living, you can't shy away or try to mask yourself from something that is never going to go away, which is emotions in the market. So let's look at cycle timeline. This is the last piece of the puzzle. If you study the markets on a monthly, weekly, daily, and if you study different market cycles, you will notice a pattern for your time frame, right? And the pattern is going to be, and I've covered this many times, is if you just do this for a span of 1 to 5 years yourself, and it could be as simple as this: market above the 10-day and market below the 10-day, right? And if you just keep a market cycle of that, you'll start noticing a pattern, right? You'll notice a pattern in the market where maybe it trends above the 10-day for a few days, and then right around day 4 or 5, or maybe some other cycle, you expect an undercut of the 10-day in the market. Nonetheless, I try to keep it versus the BP. Are we above the BP? We're going to have a positive cycle count. When we're below the BP, we're going to have a negative cycle count. And that's really what it boils down to for me. So when we're above the BP, day 1 to 3 is when you try to put on your biggest positions, or if the market allows you to put on your biggest positions, because that's when you're going to make most progress. And breath is going to pick up, groups are going to work, breakouts are going to happen, liquidity is going to return to the markets, all that good stuff. Right around day 4, 5, and 6, we expect a pullback, because after, let's say the SPY is at 4,000 and we rally to 4,300. At that point, we've rallied 300 points in a span of, let's say, 1 to 3 days. At that point, it's logical to expect some sort of pullback or consolidation. And if you think the market's just going to go up for 20 days in a row, it's happened in the past, but you have to let the market tell you. And on a net basis, when I've kept up with a cycle timeline historically, I've seen that right around day 4, 5, 6, you can start anticipating a pullback because risk to reward gets skewed. And what happens is market participants don't see value in buying stocks that are stretched out way too far from their logical buy points. So at that point, we expect consolidation, sideways action, or we expect the market to come in and test the buyers in a big way. So people that bought day 1 to 3, it will test your conviction. The market is going to talk to you and say, maybe, this is a stress test and I'm going to hold all the key levels that I need to hold. Or I'm going to just come in and go back below the BP. What we've seen this year is we get these 4 or 5, 6-day rallies, and then in late March, we had a 13-day cycle, and then we went into a 60-day down cycle. So when the overall trend or the macro situation and the Fed and all that stuff combined is to the downside, what we'll see is these 4, 5, 6-day rallies to the upside, which are basically oversold rallies, and then the market will come back in to test the lows. But for us, we keep it mechanical and fairly simple. Above the BP, positive market cycle. Below the BP, negative market cycle. And we keep it super simple, right? Because let the system work itself. And then if you guys start tracking cycle timelines for yourself, what you will see is you'll notice patterns. I can sit here and tell you that day 4, 5, 6, you'll expect a stress test, and then we'll have, you know, another trend, and then around day 9 and 10 we'll get another stress test. But you really have to experience it for yourself to develop a feel for the market. So it's good that I'm keeping the cycle timeline for you, but also keep one for yourself, right? Write these notes down for yourself. Don't just look at the daily plan every morning and just, you know, take my word for it. You have to build that experience by writing these things down for yourself so that you can have your own confidence in them, not just the confidence that I carry in them. That's not going to get you anywhere. You have to build your own confidence in these things, and you have to take it, you know, you have to experience it for you to have any conviction in it. So that's the purpose of the market cycle. The latest market cycle that we had was about, you know, 59 days, and then this was the 60th day where we reclaimed the BP. And I mean, we're about day 5 on Monday. It's going to be day 5. Day 4 we had a stress test, and we'll see how that goes. It's not looking too good when many of the stocks that we were watching, even in healthcare or any space, they were not holding the levels that we expected them to hold on the stress test. So Chewy was less than 45, BMBL less than 35, LNTH less than 70, and that tells me that the market is treating this stress test more so as I'm going to go below the BP very soon, so get out the way type of situation. So again, we'll see when we break this 39.20 level. There'll be confirmation that we're about to head, you know, south once again, and that the bounce that we saw for 4 days was just that, was just a 4-day bounce within a bigger down cycle in the markets. So that's the cycle timeline. And let's start taking in some questions so I could catch my breath a little bit and answer you guys at the same time. So Tom, I don't know if you want to talk live, but I've allowed you to talk if you want to unmute yourself and just ask a question. I just saw your hand was raised, so. Okay, so we'll take a question chat. Shiny says, when you short the SQQQ and TQQQ, do you swing for the fences? No, I don't swing for the fences. My first position that I'm going to take is usually in that 12 to 17% area. And that is what keeps me comfortable if things go against me. So I've had that, you know, this year I've had losses on the SQQQ about 2 to 3%, where I tried to time something and it didn't work out and it resulted in a loss. And you could see my full trade log on the website as well. It's hosted on the website. But I try to keep it this 12 to 17% area for my first trade. I don't swing for 30 to 40 to 50 on my first position. If a short on SQQQ or TQQQ starts working and the market continues to tell me that it's going to break these IP levels and stay below the BP, I'll look at additional opportunities to get this 12 to 17% right around to 24%. But I will not put my entire account in it. It may work, and I know you guys hear these things out there that if you don't take 60% positions, you're a loser type of vibe. But you're walking on a landmine at that point, and if you step on one, you're gonna blow up really quickly and start from zero again. And that's not why I'm in the market. I'm in the market to make consistent money. There's a time and place for such position sizing and then to go really big, but that's not this environment. This environment is not for big position sizing. So I hope that answers your question. Do you use open profits to finance more positions? That is really the goal. So for example, I place a trade in IoT at $14 and change, 1407, something like that. I'll post the exact numbers in the trade log, and I post my portfolio, a screenshot from my IBKR portfolio every time I do take a position. So let's say this rallies to 15, which it did. It uppercut 15, and we saw chop around 15, and now it came back in and completely, broke below 14 at the moment. So when it was at 15, I had about, I think it was a 6% move, and I had dollars to waste. Basically, that's how I look at it. I have open profit in the market, and I could go out there and, let's say, take a position in OLPX, which was holding 17.5, right? Now my worst case at that point is IoT comes back in and clears out all that profit, and OLPX comes back in and breaks below 17.5. My worst case scenario at that point is I lose maybe 0.5%. That's my worst case. I'm just trying to control my risk, right? Given that I have an open profit in IoT, I'm going to allow OLPX, as long as it trades above 17.5, to work itself. And when you do the exact math, you'll see that if this sucker comes back in and goes below your entry point, and this sucker comes back in and goes below your entry point, on a net basis, you're going to make a little bit of money. And I encourage you guys to run that math. And maybe I should have a visual out there to have a 12% position size, look at the open profit, and then I'll try to show you guys how the math works itself out. But that is what I'm trying to do, is when I see one position working, I'm looking at that money as I can go out and be a little more aggressive because the market's trying to work for me, right? So I try to do this as much as possible. There are instances, again, I'm not completely mechanical and non-emotional and like a god or something like that when it comes to this. There are times that I trade on feel as well. So if I feel that the market is about to, the engines are about to rev themselves and we're really going to get going based on feel, I will take positions that just don't finance my risk, but I risk a little bit more and say, okay, if everything just runs me down, I'm going to lose about 2 to 3% on a net basis, right? So there are times where you operate on feel and you take those risks in the market, but there are times when you're a little cautious and you trade and you finance your risk from one to the next. For me right now, I'm not super bullish. The system is telling me be bullish. Look to the the upside. We're above the BP, but I'm trying to finance my risk and I'm trying to just make sure that I go from one position to the next and not losing money. So I hope that answers your question. Again, there's a lot of art to this. You can't sit here and be a robot and your joints are all stiff and you will only do things based on your rules. It might work, but you will be emotional. You'll make decisions on feel, and you have to develop that. You have to deal with emotion. You have to develop a feel, plus do that within your system as best as you can. You're going to be times things don't work out as well. So I want to be completely realistic here and not, just blow some smoke up your guys' ass. So Michael has a question on how do you deal with your emotion, fear, and greed position in real time. I deal with emotion from a standpoint of, if everything runs my stop, how much am I going to lose? And I have to be very realistic about, and I'm a freak when it comes to, I just don't want to lose money in the market. That's the mindset that I operate on. If I am going to lose, how much am I going to lose? And I need to know that at all times. And I'm very specific with the entry tactics that I choose and the setups that I get involved in. I'm very specific, and you'll see me. Okay, I'll be the first to admit that this whole biotech run probably missed a good chunk of it. I'm perfectly fine with that. I know I will miss future trends in the market. Maybe retail gets going and I miss the early run, or maybe biotechs get going. But I always operate within what I think I know really well in the markets, and I carry that confidence when I'm taking that position. But at the same time, always know your open risk, and if this thing doesn't work out and you get stopped and you get run over completely by the market, have these levels and say, okay, this is how much I'm going to lose. And that's going to sort of help you deal with your emotion, or helps me deal with my emotion. You have to be completely okay with every single position that you take on running you over in the market, saying now is not the time. And if you don't know those numbers, which out of 60 or 70 people that are on right now, I bet you many of you don't know those numbers, and you operate completely on feel, and there's no mechanical aspect to what you're doing, such as knowing your open risk, right? So I feel knowing your open risk is key, and make sure you know that at all times. It will help you, and it will tell you, okay, you're risking 3% of your portfolio, let's say that. And if things don't work out, you have to be okay with that 3% loss in your portfolio. That's how I deal with it. The other thing is just know that there's going to be a point in time where you're going to make a large sum, and there's going to be a point in time where you don't make a large sum, or you don't have a triple digit year, or your expectation. Don't set lofty expectations. So for example, about Tuesday, I was up a lot, and actually it was on a Zoom with Ross. And I was saying, this is the most traction I've gotten in a while. And just a couple minutes later, things were run down, and my P&L was, I think, went from about 14,000 right back to $400 in the span of probably 3 to 7 minutes on Tuesday. But I try to operate on, I don't get too high when I'm up, or I don't get too low when I'm down. I try to operate on, I know my open risk, and I operate on that basis. The only time I'm going to make money, and a large sum of it, is going to be when I cash out that money away from my trading account into my debit. And that's the reality of it. You can have a good day, you can have 2 good days, you can have 3 good days. They don't really mean anything in the grand scheme of things if you can't, until your debit account hits, for example. So that's the way I try to operate in the market, and it helps me. You don't get too high when you have a big open profit, and you don't get too low when you lose all of it in the span of 15 minutes. That's just the reality of trading market. So how and when you consider an IP level is broken? Are you waiting on something or anything specific? Okay, that's a good question. So let's say we have 39.80, which is what we had on Friday. Market came in and it broke 39.80. Market was at 4,005. It was above 4,005, undercut, came in and went down to 39.80. I took a position right here, and I said, I'm going to short TQQQ based on the fact that we opened near the IP. We opened near the IP. That's a key. We came back down. I didn't take a position here because there were 2 things in mind. Either we're going to get directional or we might get chop, right? So those were basically the 2 things that I had in mind. So I took the TQQ position when we broke 39.80, and I said, if the market is going to maybe come up, rally, chop around, or based on the fact that we open near the IP up here, I'm expecting this to go down a little bit more. So first thought process is we're going to get directional movement on the day. Why? Because we're opening near the IP. That's the first layer of thought that I have on a consistent basis. Second is when the market breaks the IP, I took a position in TQQQ, short, right? Expecting breadth to be poor below that 39.80. And I've seen this play out not just on Friday, but 3 months ago, 3.5 months ago, 6 months ago. And there are situations that I have in my mind where I've seen this exact thing happen according to the daily plan that gives me confidence that this might happen again. And that's the important thing, is you want to visualize this again and again. Maybe you should have this particular day printed out, because this situation, maybe the numbers change. Maybe 4,000 changes to 3,000 and 39.80 changes to 2,700. But you will see the situation again in the markets where we open near the IP, at some level, we break above it and we come right back down, and there's an IP level to the bottom side, we break below that, it will be the exact same trade in a different situation. So I've seen this play out, and that's the third layer, is you have visual evidence of this working in the past. And if you don't, then you're going to be uncertain. And when you're uncertain, you lack conviction. And when you lack conviction, you don't make any money. Right. So that's a process you have to go through. Signing up to private access and paying an annual fee is not the gateway to success. It's to visualize what we're trying to teach here for yourself, for you to be successful. So I'm not gonna, again, blow smoke and say you guys paid a fee and you'll be very successful. You have to go through these thought processes for yourself to see it in real time and be successful. About cycle timeline in day 4 above BP like Friday, when to hold or when to sell. It's very clear. I mean, let's say you take a position on a stock at 35, goes above, it chops around, and then later in the session, when we break 39.80, the stock is also breaking 35. Market is telling you whatever your thesis was about directional movement off your pivot, that directional movement no longer applies, and your thesis of taking that position and seeing directional movement off 35 is incorrect. And when the market is telling you that on the daily plan, and it is telling you that on the individual stock basis, you have no right to question that, and you have to take your money and run, or take a small loss and run at that point. So that is how I know. Maybe I'm dead wrong for selling everything on Friday. I'm absolutely okay with that. But the market will reset and set up into a position. The market will reset and set up into a position where eventually I'll be in a state where we can, again, make some progress. So it's not FOMOing or anything like that. It's you're dealing with the reality of what is and not what you think it is. So does it always work out? No. Does it result in losses of 2 to 3% sometimes? Yes. Does it mean that we might see a Monday morning gap up and everything's going to be patched up right quick and we have to adjust to that situation? Maybe. So all those things come into play, and we have to operate based on what we see and not what we think we see in the market. Where is your trading journal posted now? Let's go to the weekend routine. And let's see, let's pick this one. It's right here, trade log. And here it is. This is the positions or the trade log, if that's what you're asking. So I've had losses, I've had decent gains this year. And then I also have to update this. I'm well aware. So I'll be updating it today. You'll see my recent trades down here. But this sort of tells me if I'm on the track. But, you know, much of the year, you'll see there's not much going on. It's very little to be had in this market. When you say 12 to 17% positions, are you including margin? Yes, I am including margin. And you have to be comfortable with that. Some people are comfortable with sizing versus their cash, which is perfectly fine. Nothing wrong with that. But I am calculating versus margin. Is more info on how, so that is the last slide. FAQ. So we post this 1 hour before the market open on TL Private. Does it follow IBD rules? It has nothing to do with IBD. Is the data proprietary? These levels are calculated overnight through a script that I've developed, and the data is proprietary basically. So how do you compare the BP IP system versus floor trader pivots? FTP is located between IPs. I've observed that price also breaks it. Okay, floor trader, I mean, it has nothing to do with floor trader pivots. I could tell you that for sure. But if you have looked into floor trader pivots and the market is consistently dancing around them, and you could develop a system around that, I would encourage you to, do that, and maybe make a post on the forum showing folks how we could use floor trader pivots to accomplish this. But I personally have not looked into floor trader pivots. I used to look at yearly pivots in the market, where you calculate the yearly pivot and then price would come back down to the yearly pivot, almost, I think, 50% of the time in a correction, and we would get bounced off the yearly pivots. That was something I experimented with a couple of years ago. Where do you have your stop on TQQQ? My stop on TQQQ is correlated with how the market is going to be. So if I take a position at 39.80 and the market ends up closing above 39.80, let's say at 39.95, I would take my loss, which would probably be 2 to 3%, and say that whatever I did was completely wrong and the market's saying just get out. So I will take that loss and get out. As long as we close below that 39.80 level, I will continue holding TQQQ. When stocks decouple and run while the SPY is chopping, what is the thought process? We've seen some of that. We've seen software names probably rally 40, 50, 60% off the bottom. Personally, I don't have much success of picking something down 90% off the highs and rallies 20% off the bottom. I try to look for something that's, coming up the right side, strong trend, and I have more confidence in those trades. But the decoupling that you're talking about over the last week has been software bouncing off the bottom, cannabis bouncing off the bottom, but we need these initial runs to be sideways and secondary entry areas. And that's just my style of trading. There are people out there that try to, pick bottoms and will get a 20% run. But if you look at it from an aggregate 6 to 9 month basis, maybe that gives you a little bit of a thrill and excitement and gets you going. But on net basis, it's a tough setup to develop. And if you have a setup that you've seen that works, like a mean reversion setup out there, share it on the forum. I want to develop one for myself eventually, especially after the Weinstein course is out. So we'll see. But I don't go out there following people where we get 20-30% rallies off the bottom and they time those. I don't have anything in my toolbox that allows me to do that at the moment. With up to 20%, 27% exposure in your day trades, how did your EC move for the week? So on a net basis, I think I didn't make much progress because I allowed IoT to come back in and take me out flat. I allowed OLPX to come back in, take me out flat. I think I took half off at $15 on IoT, so I made a little bit of money. And then TQQQ, I put on a 12% position on the break of 39.80. But overall, I think I maybe made 2 to 3% on the week, but that's mostly because of IoT and TQQQ, but nothing huge. SWIR, I had a position at 24 area. It came back in and didn't do anything. LNTH is one I was watching versus the 70 spot. It came back in and undercut 70. I didn't take a position in that. So what's the theme here? The market's just saying things are not working to the upside. So it is what it is. So a lot of the stuff that maybe was working came back into flat. And overall, the progress wasn't that much. That's a good suggestion. Any option to automatically mark IP levels at the daily plan every day. We have a trading page, but we haven't figured out how to do that automatically yet. But you could go on this trading page where the daily plan is right beside it. So this was the break of 39.80. We came back down to 39.38, and the bull to pivot was 39.20 right down here. We opened at 4,005 area. We didn't get directional. We undercut and chop around 4,005. came back in, tried to rally above, didn't, and we came back into 39.80. So not asking to pry, but just trying to compare how trading SQQ as a day trades rather than trying to open positions. I tend to short TQQQ and SQQQ. The reason being there's more alpha to the downside on both of them. I'm not sure what your question is around that. There's a question by Casey. It says, I know you mentioned before you won't use options. Any thoughts on using that as a form of leverage? Options require timing. Options require you to time the markets very specifically. Options require you to have a knowledge on what decay is and what Greeks are, what the Black-Scholes methodology is and how pricing is calculated on that. So one of the first questions is, do you know what decay is? Do you know these Greeks, the concept of these Greeks really well? And what this model, this pricing model that is used in the market, do you know all these things? And out of the people that are watching, I would guarantee none of you know much about it. The reason being, it gets very complicated in the markets. There's IVs as well. You have to know really, what implied volatility means, what a derivative of implied volatility is. And it gets really complex. And it requires a lot of knowledge in the market. So unless you have all that knowledge and you know this at the, from the back of your hand, I would encourage you to at least first study what options are, how pricing is calculated, what the Greeks are, what IVs mean, how events have impacts. So near the Fed event every Wednesday, premiums might be a little bit higher because market makers are trying to, juice the premium so that they can crush that IV. And there's a lot of these things in the option space and they require a lot of knowledge. So I would encourage you to first look at it, have a clear understanding of what you're dealing with. And then on top of all this, like if you think you're a smart ass, right? On top of all this, you have to time it properly. So you get in here, 39.80. Maybe you go short, a weekly expiration, and you need price to move. If it doesn't, you're gonna lose you're gonna lose it. So that's what I tell traders. I mean, you can do it. I'm not saying it's not possible, but study options. There's a lot to options than just buying a weekly strike and saying, woohoo, I've done well. They might work, and then the other, the next day you might go into a position and the IVs crush you because there was some event or premiums are jacked up because earnings are coming up. So there's a lot of variables to options that we need to know about. Saw you have a good cushion on a name, 10%, and we undercut an IP. How are you handling that? That's a good question. So the way you handle that, this is a question by Robert. How do you handle if you have a cushion and we undercut an IP? Look at what your average winner is. And if your average winner, if you have a 10% cushion, we break an IP, right? And your average winner is less than, let's say, 6% over the last 20 trades, for example. Then you take half off or a third off. You have to take something off because you're anticipating weakness in the market. And that name being up 10% is sort of unusual because your average winner has been 6%. So that's how I deal with that situation. Now, that name that you is up 10%, market breaks IP, comes down to 6%, and then rallies back up to 17%, let's say, for example. This is all hypothetical, right? How do you deal with this situation? You just sold and you got suckered out for half your shares or 30 your shares. And now the market's saying, look, you should have kept all your, position in there. This is going to happen. It happens. The goal is when you're going to get that big winner, even if you have a 2/3 position in it, you're going to make a large sum of money. So this whole thing where I have to be perfect, not sell anything and know everything, about, know everything about how this position is going to behave because I know how to manage winners and I'm trying to be perfect. It's not going to be perfect. In 2020, when I had a position in LVGO and it became one of my largest positions in the market, by the time I hit a 50 or 60% open profit, I had sold a third of my position. Had I kept the full position, which ended up being up about 450 to 500% from entry point, I would have made a lot more money. But that doesn't mean that this is a 2/3 position that I kept. It still made me a good sum, right? So hypothetically, I'm just trying to deal with risk, and if I get a big winner in the market, it will make me some money. But I don't really have a perfect, crystal clear plan, or a blueprint on. I didn't know this was gonna blow up that big from $20 to $100 or something like that, and get bought out. So dealing with uncertainty, knowing that we don't know that these things might double, triple, quadruple in the future, you just have to manage your risk along the way. And sometimes you'll sell winners early, sometimes you'll have winners that act perfectly and allow you to stay in. And as long as you do that consistently, and you'll make small tweaks along the way. But I don't have a particular blueprint where I look at a LVGO and say, yep, this is going to be up 400%, and we have to hold a 100% position in it. I don't have, I would again be lying to you if I said I knew it was going to blow up that big. Okay. Are you creating a video on day trading? No, I'm not creating a video on day trading. This service is for swing traders and position traders. And I'm not going to make a video. There's too many of you that are in the consistency phase, just trying to stop that loss on your equity curves for me to throw in a new wrench and say, let's go day trade and have some fun. Not going to happen. I did think about it, but it's not going to happen. What ETFs we should look at to assess sectors? So that's a good question. Probably a power pack question. I'll probably answer it after the fact, but just your majors, like for solar, you could use 10. For IBD 50, you could use FFTY. For breakouts in the market, there's actually an ETF called BOUT, BOUT. You could take a look at that. BOUT and FFTY, BOUT and FFTY are both Investor Business Daily ETFs in the market. So for healthcare, technology, XLK, but cloud computing, there's CLOU is an but I'll post a list. One list that was good over the conference was Patrick Walker's ETF list. So I'll probably repost that for you guys to see. I think that was a fairly good list that covered different groups in the market. So I'll post that on Tail Private after. There's a question, our hold number is always 70, 75 versus what if it's 71, 72? So let's say 70, 75, we have 71, 72. So I consider these two hold numbers, not 71, 72. Do I mainly do my studies during the weekend? I'll be honest, in the past year, trader lines become so big, and I'll be quite honest with you, what turned into just a thing to help people has blown up into something a little bit more. And what me and Richard were talking about this the other day. We just want some time to just study the markets and do what we used to do, right? Now it's work on the Stan course or work with Stan and then hop back, do a webinar with Teal Private, then try to, fix this, patch that in terms of orientation flow. So it's become a lot more than just, trade, help a few people, do your studies, try to get better. And we want to get back to that. We'll have a couple of months into the end of the year. We'll slow things down and it'll be a lot more peaceful, and we could just trade the market and, help people and do studies. So I want to get back to that soon. Talking about dealing with uncertainty, how do you manage a big gap down both EC and MC. So how do you deal with a gap down? That's a good question. So let's say we have an open profit of 2 to 3%, and market gap's down, and we're now down 1 to 3%. Now we're negative. This is positive. And we just suffered a huge gap down. Say we're in a biotech, traded at 17, opens at 8, right? You landed on a landmine. Biotech, bad news comes out. You just lost your shirt. First is don't size biotechs the same as tech stocks. That'd be one thing. Don't do that. There can be times where I've seen the most experienced traders, and probably Ross back in 2018 was long one of the biotech stocks, very liquid, institutionally backed, proper setup, everything, blah, blah, blah. And that stock gapped down on him 30%. And it was a biotech stock. And it was just news, FDA, blah, 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 didn't approve, and time to lose your shirt. And what saved him and allowed him to recover from that was his position size on it wasn't too heavy, because he knew the risks that he was dealing with. And it's very important for you guys to know it's all, rosy out there when your biotech moves from $3 to $12 or $15, and FDA approves something overnight and you're up 100, 102. I've been in those situations where it gaps up, but you have to think about the other side of the equation when it gaps down. So don't size biotechs the same way you do. I know that was not your question, just something that I want to say. The second is, when the market tells you you're wrong, don't start wishing that you were right and you are right in that current moment. As soon as the market is telling you, no, you cannot do this, and you're down and you're wrong, take that to the chin and just survive that situation, because that survival will get you to a situation where you can make it back. If you sit there and you're stubborn and you think you're right and your ego runs high and you put yourself in a deeper hole, what's supposed to be a 1 to 3% maybe turns into a 5 to 7, and then 8 to 12. Just give me 1 sec. I just want to make sure the Twitter messages aren't, we can't hear you. Just give me 1 second. No, we're good. Yeah, so when you're wrong, take it to the chin, move on to the next situation, survive that situation. There are times that happens. Let's say I'm trying to recall once early in my trading, I think it was the PINS IPO or something similar to that, Snap, or back in the day, something similar to that. One of the IPOs, I didn't know they had earnings within 30 days of doing an IPO, or 45 days of doing an IPO. And because that's not usual. Usually you don't have IPOs reporting, a week, 3 weeks into when they're public. And I stepped on a landmine and I was down, I lost my shirt. And then what's the lesson from that day? Well, the lesson is know your earnings dates and deal with that situation, cut that loss, flush it. Market will put you in a situation eventually where you may make it back and you'll get back to that point. But don't sit there thinking you're gonna outsmart visual evidence that shows a damn red number on your screen and think that you can outsmart the market and you're right and the market's absolutely wrong. So that would be, there are going to be situations. I will be in a same situation. Maybe, we don't know which day, but eventually we will all be in that situation one day. And the way you deal with it is you have to cut your loss. There's no other way. And the worst part is when you cut your loss, thing gaps down 10%, 12% on you and closes the day flat. And then you look back saying, damn, if I held it, I would have been flat. But you have to deal with what you have in that situation. You can't sit there and, try to outsmart. That's a lot of what people try to do. Oh, I got gapped down 10 to 12%, time to hold and, be fancy. And look, Now I'm flat on the day. Well, in hindsight, that might, after the fact, it might be good, but it could have been reversed where something 10 to 12% might now be down 14, 15, 16, 17% after the fact. So when you have a situation that you're not comfortable in, cash is going to make you comfortable and get your emotions back down so that you can recover from that situation. So go cash when you run into something like that. Doesn't matter what happens after. Yeah, I'll post the Patrick Walker list. I have a screenshot of it. I have it saved. I'll post that. You mentioned testing the BPIP system through NASDAQ. Will this be released soon? Not anytime soon. I'm trying to, so our priority is going to be stand course, get that out the door July 30th. Then it's going to be deep view, going to be released finally. And we're aiming for second week to send out the first 50 invites in August. It was supposed to be released July 30th, but the stand stuff takes a little bit of precedent, or like takes a little bit of a priority. But we're gonna have first 50 invites sent out for deep view in the second week of August. Thanks. I think Shiny posted that 9th page has Patrick Walker ETF list. Perfect. Awesome. Thank you. I'll post it on Twitter as well, so everybody gets to see it. Yeah, so if you guys have any other questions, if someone wants to unmute themselves, talk, I'm open to that. We're about 1 hour into this, hour 15. Any questions on daily plan, any questions on anything, more than happy to talk about them. If not, we will end it here and the recording will be posted later today. Perfect. So one last thing, again, Stan Weinstein Masterclass, annual private access members. You should have gotten an email for a massive discount versus the public pricing, $500, $600, $700 off for annual private access members. And I hope you guys, join this. There's a lot of effort going into it. About 5+ hours of Stan himself answering questions. We had a huge list of questions for him, and I think the amount of effort that he put into it justifies. We're trying to be fair to our annual members. We know you guys paid an annual fee, but this type of deal where you get $500, $600, $700 off pays for itself. So with that, I hope you guys have a good weekend. The weekend routine is I'm going to start after I have some breakfast. Will be posted with a video walkthrough. I'm also I did a chart recording yesterday that will also be posted today. And then I know I have to get you guys another video on market cycles. So that presentation's ready and I will be recording that as well. So everything that was promised for this month on the July calendar is going to happen, and it's going to happen before the 30th. And that's a promise that we have to hold when we release that calendar. Sometimes we don't hit the dates that we want to. Situations happen and we get more busy elsewhere, but all that content is going to be released. So with that, I hope you guys have a good weekend and